Oftentimes you miss a rally. Let's say you had support down in here, you didn't buy it, and it did pop. So what do you look for? Maybe a pullback because you're still bullish and you think ultimately it's going to go and recapture that high. And maybe other reasons why you're bullish. So you look to buy the rubber band as it retraces and does what? You think it's going to do this. So you're trying to buy a pullback instead of getting stuck at the high reaching. But you still need to qualify that because you don't want to get stuck with price zipping right through and you have an immediate loser. So it's all about qualification. That's always going to be where your better locations come from. And so in our OPP, other people's positions, without getting complicated, keep it simple. If you're looking to get long, do you want more longs or less longs? Less longs. You don't want competition. Anytime someone asks you, do you want a lot of other longs when you're long? No, you don't want other longs when you're long. You don't want other shorts when you're short. That's competition. So take a look at these numbers. That's over 2 minutes. The reason why this is green is because there's more longs than shorts. 57 to 37. Pretty simple, right? So if you're long, you've got slightly more longs in the market. What did we say? We want less longs. We don't want more longs, we want less longs. So watch what happens when we play this. Watch these two numbers come in and flip. Did they just flip? Yes. So now when we pause it, we could say there are more shorts than longs. Do we want that if you're long? Yes. You want shorts when you're long. You want longs when you're short. I know that's counterintuitive, but you have to just do the math and run through that logic. We also get a move down in our 60-minute OPP. This guy right in here. The number on the right gets below 200. So it's qualifying a chance to indeed kick back up. This isn't just an example of something that works or when it works. You can watch it and you could see how generally the next right side is up. And you could see how it comes in and pops. Take a look at this chart. Qualifies a moment that your location in an area is going to be kind of the low of the pullback. You know what sucks is when you are right with your opinion, but you're down money. You're on the right side of the market, but your locations suck. And you are buying it. Let's say you're buying it here and the market drags a little lower, and then you're in, you're out, and you take another shot and you get stopped out of that one, and then the market finally rallies, right? You were right. You kind of knew the trend overall, but you can't get that location. Your timing is off. Timing is key. Timing is where it's all about. You actually put yourself in a position with a great location to be wrong on your bias and still make money. You know, you could be fighting it, but your locations are excellent. And locations come from good, important technique or the tools to qualify and disqualify what you're trying to do. If we drag this all the way back, it was bearish to bullish. And we told the group, like right in here, now you got to be careful because it was just the opposite of the previous day, where today we open and go straight down. What happens? Watch my prior video. Yesterday, we had everybody get bullish because it opened up and rallied. And everybody follows kind of that herd mentality. So everybody is bearish because we open up and break 10, 15 points. Boom, we come right back. And you can almost rest assured that now you got people trapped short. More shorts, more buyers. More buyers, always needed for the price of anything to go up. And so you could see this thing slice through prices or areas that are generally excellent resistance. That's sometimes the best clue of all time when it doesn't stop, and it should, right? When it doesn't stop, and it should. That's what we refer to as B to B. In this case, bearish to bullish. Transitional moments is where you're going to make better and better, create better and better opinions, higher probable opinions that you'll be right and being at the beginning of it, some sort of change. You want to be change. You want to be recognize change, but be on the cusp of it. That's why if you ever got an economic number earlier or right when it was released, there'd be all kinds of opportunity. You're at the beginning of some change of an important piece of data that missed, but you got to be close to when it happens. If someone comes out and says something, some Fed speaker that's really bullish or bearish, doesn't do you any good to hear about it 5 minutes ago. And so it's like the transition, the beginning of the transition. There seems like, wow, there's a lot going on these charts. There really isn't. Just, again, it's a repeat, different time horizons, but it's the same two or three tools, just creating a sense of where and why are people trying to buy it here, sell it there? Are they long? Are they short? Most people in this business don't ask the right questions. It's like, where do buyers come from? They come from shorts. Where do shorts come from? Do you realize that the market is marketing you all the time, trying to get you to participate, open a long, open a short? It's marketing, it's advertising to traders all day long, trying to attract investors, trying to attract people opening positions, right? And so, where do buyers come from? If you're long, what do you need to happen after you're long? You better get buyers that come in, because if you're long, you think price is going up. What do you need? You need more future buyers, right? Where do they come from? Start asking those questions and get you to more effectively brainstorm creating better location, better timing for what the hell it is you're trying to do. But you don't want more shorts when you're short. One other thing I'm going to put in here. I think it was right in here. Was it right here? Oh, we had this big kick down in you don't see us off the screen. Yeah, we'll go over that in the room tomorrow.